Hi, everybody, and welcome back to video number 8 in chapter 20. And when we left off, we were looking at the summary of the treatment of residual values from the lessor's perspective. And the classification test we are going to include, and the measurement of receivables we are going to include under the guaranteed residual value scenario. But under the unguaranteed residual value, we'll ignore the classification test and include the measurement of the receivable. Okay, so one note here, when residual value is not guaranteed in a sales type lease, lessor will reduce the sales revenue and cost of goods sold by the present value of the unguaranteed residual value, as we had shown earlier. Okay, other lease adjustments. Additional lease adjustments that affect the measurement of lease assets and liabilities are going to relate to the following. Number 1, executory costs. 2, lease prepayments and incentives. And 3, initial direct costs. Now, executory costs are normal expenses associated with owning a leased asset, such as property insurance and property taxes. These executory costs are included in the fixed payments required by the lessor and should be included in the lease payments for purposes of measuring the lease liability. Payments here by the lessee made directly to the taxing authority or insurance provider are considered variable payments and are expensed as incurred. Okay, let's look at the gross versus net leases illustration. Here, the Ortiz company enters into a lease arrangement to lease a retail space in a shopping mall from Bryant Incorporated. The lease term is 2 years with monthly payments of $15,000 per month. In scenario number 1, Ortiz does not have any obligation to pay any of the property taxes or property insurance on the retail space. Ortiz estimates that Bryant is paying approximately $1,500 per month related to these executory costs. In scenario number 2, Ortiz must reimburse Bryant Incorporated for the property taxes and property insurance or pay a third party directly. The question, therefore, is how should Ortiz account for executory costs in each scenario? Under scenario 1, Ortiz and Bryant have a gross lease arrangement in that property taxes and property insurance are included in the rental payments made by Ortiz. In this arrangement, the payment for executory costs is fixed per the rental agreement and should be included in the computation of the lease liability. In scenario 2, Ortiz and Bryant have a net lease arrangement because the lessee makes variable payments to a third party or to a lessor for the executory costs. In this case, Ortiz is responsible for paying directly to the executory costs, and therefore it is a variable payment which is expensed in the period incurred and not included in the lease liability and right of use assets. Okay, special lease accounting problems for other adjustments, and these include prepayments and incentives. So lease prepayment incentives are when the company adjusts the right of use asset for any lease prepayments, lease incentives, and initial direct costs made prior to or at the commencement date. Number 1, lease prepayments made by the lessee increase the right of use asset. Number 2, the lease incentive payments made by the lessor to the lessee reduce the right of use asset. And number 3, initial direct costs incurred by the lessee, discussed in the next section, increase the right of use asset. Okay, so if we look at a little equation here, our right of use asset is equal to the initial measurement of the lease liability plus prepaid lease payments less lease incentives received plus initial direct costs. Okay, so let's take a look at initial direct costs. We'll go back quickly. Here's our initial direct costs, which we're adding. Okay, they are incremental costs of a lease that would not have been incurred had the lease not been executed. So examples of costs included and excluded from initial direct costs from the lessee and lessor side. So what would be included are commissions, including payments to employees acting as sales agents. Here, legal fees resulting from the execution of the lease. Number 3, lease document preparation costs incurred after the execution of the lease. And 4, consideration paid for a guarantee of residual value from an unrelated third party. But what would be excluded would be employee salaries, internal engineering costs, legal fees for services rendered before the execution of the lease, negotiating lease terms and conditions, advertising, depreciation, and costs related to an idle asset. Okay, let's take a look at an illustration. Here, the Mangen Company leases solar equipment from DeMalley Company for 8 years, starting January 1, 2025. The lease is a finance/sales type lease, and the terms of the lease are as follows. 1, DeMalley will pay Mangan $30,000 as cash incentive for entering the lease by January 1, 2025. DeMalley pays initial direct costs of $5,000 for legal fees related to the execution of the lease. Number 3, Mangan incurred $1,500 of initial direct costs, that's commissions paid to the lease negotiator, which are payable by January 1, 2025. 4, Mangen must pay not only the first rental payment of $10,000 on January 1, 2026, but has to prepay the last month's rental payment on December 31, 2025. And then number 5, the initial measurement of the liability is $400,000. So the question is, what is the amount to be reported for Mangen's right of use asset at the commencement date? So the measurement of the right of use asset for Mangen is going to be as follows. Here's our initial measurement of the lease liability, $400,000. The cash incentive from DeMalley, the lessor, we subtract $30,000. The initial direct costs, that's the commission paid to the lease negotiator, will add $1,500. Prepayments made by Mangen to DeMalley before the lease commencement, $10,000. And if we sum that all up, the measurement of the right of use asset at January 1, 2025 is going to be $381,500. Mangen, therefore, is going to report the right of use asset at $381,500. DeMalley, the lessor, expenses its initial direct costs in the period incurred given Damali reported a gross profit related to its sales type lease. Okay, so now initial direct costs and internal costs. Here, for lessors, initial direct costs often are more significant because they are usually the party that solicits lessees as part of their sales activity. As a result, lessors often engage in attorneys to prepare the legal documents as well as pay commissions incurred in conjunction with the execution of a lease. So, the lessor accounting for initial direct costs will depend on the type of lease. For operating leases, a lessor defers the initial direct costs and amortizes them as expenses over the term of the lease. But for sales type leases, the lessor expenses initial direct costs at lease commencement in the period in which it recognizes the profit on the sale. An exception is when there is no selling profit or loss on the transaction. If that is the case, and there's no selling or profit loss, the initial direct costs are deferred and recognized over the term of the lease. Now, what about other internal costs that the lessor incurred related to leasing activities, such as advertising, servicing existing leases, and establishing and monitoring credit policies? Well, what about costs for supervision and administration, or for expenses such as rent and depreciation? Well, one, these internal direct costs should not be included in initial direct costs. Number two, such costs would have been incurred regardless of whether the lease was executed. As a result, internal direct costs are generally expensed as incurred. All right, a bargain purchase option. This allows the lessee to purchase the leased property for a future price that is substantially lower than the asset's expected future fair value. If a bargain purchase option exists, the lessee must increase the present value of the lease payments by the present value of the option price. So, short-term leases. A lease that at the commencement date has a lease term of 12 months or less. That would define a short-term lease. Rather than recording a right of use asset and a lease liability, lessees may elect to expense the lease payments as incurred. Renewal or termination options that are reasonably certain of exercise by the lessee are included in the lease term. Okay, here we'll take a look at an illustration, and for the Thomas Company, who's the lessee. Alpha here, Thomas Company enters into an arrangement to lease a crane for a 6-month period with the option to extend the term for up to 9 additional months in 3-month increments. After considering the nature of the project, Thomas determines that it expects to use the crane for only 9 months and is therefore reasonably certain that it will exercise only one of the 3-month renewal options. Bravo, Thomas Company enters into the same arrangement as in Part Alpha, but the project for which the crane is being used is now expected to take 15 months to complete. After considering the nature of the project, Thomas determines that it expects to use the crane for 15 months and is therefore reasonably certain that it will exercise all 3 renewal options. The question is, how should Thomas report these 2 situations? We'll have to wait to take a look at that until our next video. Until that time, bye for now.